investment planning. When we talk about investment, why do you want to invest? What's the act of investing? The act of investing is actually the act of committing money now into an asset or item in expecting that you want to receive more money. When you want to invest, most of us, or if not all of us, wants to see our money grow. That's the very act of investing. Let me share with you that there are 4 essential concepts that we ought to take note when it comes to investment planning. The first one is the risk-return trade-off. What do I mean by risk-return trade-off? If I were to ask you, with a higher risk, is it guaranteed that you have a high return? The answer is no. With a higher return, is it guaranteed that you have a higher risk? The answer is yes. As you can see, risk-return trade-off are very essential when it comes to investing. If you want to have a higher potential return, we need to take a higher risk. If we cannot afford to see our money losing our money, if we want to preserve our capital, we are unwilling to risk, then with a lower risk, likely the returns will be lower. The next important concept would be time horizon. When you want to invest, what is your time horizon? Would you like to receive your money in the next 5 years for your down payment of your property purchase? Would you want to receive this money for your education funding for your children? Or even this money, are you receiving this investment 20 years down the road, 30 years down the road for the purpose of your retirement funding? What is your objective? What is the reason behind investing? Your timeline involved. The next thing, diversification. Many of us are familiar with diversification. The common definition of diversification is do not put all your eggs into one basket. Let's use this example. Let's say if you want to invest in an equity fund. You chose to invest in a Singapore equity fund. You want to invest in the ASEAN equity fund. Now that you also consider wanting to invest in the emerging markets, you want to invest in the US and Europe. It is diversified portfolio geographically. Is this what we call a diversified portfolio? Essentially, when you look at this portfolio, it is diversified geographically. But then again, it is also not diversified because all the investments are placed under one single asset class, and that is equity. What happens? There's a crisis that comes along. All the funds, will it be affected? So if we want to diversify, the preferred or a better method would be diversified into different asset allocation. It brings on to the importance of doing asset allocation. That means to say, putting our investment into different asset classes, because in the event that the crisis comes, the different baskets of investment in the different asset classes cancel out each other, the losses are mitigated, the risks are mitigated. And obviously, we have to invest in accordance to our risk appetite as well. What kind of risk can you afford to take? It brings us into the key considerations when it comes to investment planning. Like I mentioned earlier, the reason and the purpose for investment planning is very important. Knowing your risk appetite on a scale of 1 to 10, 10 being extremely aggressive, 1 being extremely conservative, that you cannot afford to see your capital being lost. You are not prepared to lose your capital. You are very conservative. On the other hand, you are extremely aggressive. You do not mind, and you are willing to exchange higher potential returns with higher risk. What is your risk appetite. The next thing to consider would be the time frame, which we have mentioned and touched on earlier. Maintain a diversified portfolio of investment to reduce the risk. Obviously, we also need to be realistic with our returns. Many a times we understand or we want to earn more money. We want our money to grow faster, harder, better for us. Then we look into instruments that are highly risky, thinking and believing that these high-risk products itself will be able to get very high returns. But then again, are these products really able to help you? Are you being realistic with the kind of returns that you are getting? Are you looking for 50% return, 60% return? What kind of returns? Is it practical? Is it pragmatic? And obviously, when it comes to investment, we also ought to invest and monitor our investment on a regular basis. And at certain times, in fact, at all times, whenever we place our investment, we must also be conscious of the costs involved, the transaction costs, the investment charges. Do you really understand what you are buying? What are some of the associated risks? And what are alternatives that are available? I want to summarize this part into 3 essential areas that you can think about. Should you really want to invest? Invest according to your risk appetite. Should you want to invest according to your risk ability. And also consider your risk capacity. Risk appetite I have mentioned and explained earlier. Risk ability. If you are a high risk investor, on a scale of 1 to 10, you being a 9 and 10, but you have debts to pay. You have children to support. You have dependents to support. Are you able to take the kind of risk? Do you have the risk ability to venture into this investment? Risk capacity, the last one, the essential one. For example, you cannot afford to take risks. But then again, you would like to have $1 million, $2 million in 20 years' time, but all you can afford is you can only save $2,000, maybe $2,500 per month. But then again, you cannot afford to take risks because you will prefer to see that your capital is being preserved. All you are willing is probably you're looking at 1% returns or less than that. If you were to adopt such a measure, will you ever achieve that amount that you desire? 1 million, 2 million, when you are only prepared to save $1,000 or $2,000 at a growth rate of 1% per annum. So when we want to invest, 3 essential areas to consider would be risk appetite, consider your risk ability. You ought to also consider your risk capacity.